Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus. Joined today from his home office in Long Island, I have Todd Anderson with me. How are you doing, Todd?
I'm doing well, Peter. How about you?
Doing fantastic. And back fresh off the plane from Las Vegas, we have Kevin Travers, who has spent the week at Money 2020, just made it into the studio in time. How are you doing, Kevin?
It is great to be back. Let me tell you, what a city. Ooh.
Well, we're gonna hit on a lot of the Money 2020 themes because there was quite a bit of news coming out of that conference this week. So maybe we can kick it off with probably the biggest, the most talked about story that I've been seeing anyway is the CFPB, Rohit Chopra talking about a new open banking rule that is coming up because let's face it, it's not easy to change your bank. I mean, I look at my bank and I've probably got 100 different things that are coming in and out of that bank account, and to change all that, extremely difficult. But he's talking about creating like an open banking framework that will allow switching between banks and credit card companies much more easy. So, Kevin, you were there. What was there? What are your? Did you hear much on this particular topic?
There was a ton of talk of regulatory and compliance things and how regulators are sort of finally catching up. This article from John White, our editor, was a pleasure to work with him there because he had a bunch of fun being able to write it and put it up on the thing because it was the talk of the town, but he was one of the first to get it out. So
It was.
But yeah. And it just sounds like a good thing. I know there was a panel afterwards. There was Curtis Lin from Pinwheel. They were talking in like a little regulatory roundup and saying they're finally catching up. There's finally some urgency around this. If you're someone like Plaid who sort of relies on your own open banking rules, this might be a competitor almost, but I think it's a good thing. It makes it easier to switch bank accounts.
Mm-hmm.
Well, one thing I'm curious about is because in the UK, it has not led to a large switching.
Right.
If you look at the switching numbers in the UK and I think Europe overall, they're still really low, and they've made it, easy. I think they have something called the, something switching machine. So, I know that they track every month, and Starling and Monzo and others have been near or at the top of that list very often, but it still doesn't happen in bulk, which tells me that people are in a lot of ways apathetic, and so I'll just stay, or they have multiple things and just kind of move money around to the multiple things that they have, which seems like the way people are, behaving now. Because I mean, what was the study in the John's article? I mean, half or more people have a secondary account in addition to their own account. Right. So I'm not convinced on the switching side. I do think the open banking is catching up to the rest of the world, especially the UK and Europe. And that can only be good for the consumer because they should be the ones getting better prices, competition for those prices, and ultimately better services for as low as cost as they can possibly get.
Yeah, no, I think inertia is a powerful force, and I don't think this is going to suddenly mean huge numbers switching, but I think it will be, given if this is done well, I think we'll see an increase. There's no doubt about it. But we should also say that this is a proposed rule. They're going to have a guideline released soon. The rules expected to be detailed by late 2023 with implementation in 2024. So, which is pretty fast.
So maybe by 2030.
No, we'll see. We'll see what they say. But man, Rohit Chopra, he does seem to mean business, and of course his agency is under a bit of fire in general. But we're not going to get into that here. But clearly, I think they're trying to do what they feel like is the right thing for the consumer. Okay, staying with Money 2020 and the announcements there. I know, Kevin, you've written a piece. We haven't published it yet because we haven't got around to editing it. But Marqeta, I thought this was a really big deal. Marqeta has released a suite of banking products. They're calling it, really mysterious name, Marqeta for banking. And it's got like 7 products. Oh, this is amazing. It's basically everything you can think of. Checking account, direct deposit with early pay, ACH payments, free ATMs, cash loads, bill pay, instant funding. I mean, this is a they've basically given all of the major use cases that people use their bank account for, and they've sort of packaged it up in this banking as a service product. Well, Kevin, I know you wrote a piece about this. What are your thoughts?
I think it's great. Marqeta's a huge name in fintech. They've been around since before I think fintech was a word. Jason Gardner took to stage and talked about that. And it just sort of seems like an evolution. I talked with Randy Kern, the CTO, and he said the same thing. It's like, this is an evolution of being able to offer our customers an easy, innovative, as much details or as little details as you want, but you can build anything you want with their cards. And now it seems like it has the same functionality with banking. We're going to see like Uber and all these different people have their own specific banks. It's like a sign of the times catching up, but also sort of a wave of the future that embedded banking and like customized banking is sort of here to stay. I know Marqeta's stock has been down because all fintechs have been, frankly, and Jason Gardner is stepping down. So it's sort of like it's a difficult time for, I think, the industry in general, but it's cool that they were able to launch this news because I think it's going in a good direction.
Mm-hmm. I mean, I think this is the type of story that is the next phase of fintech. And really, if you were an early stage fintech now compared to 5-10 years ago, the bevy of choices that you have to just add products on is, I mean, it's huge. Yeah. And then you get Marqeta, and we'll talk about Adyen and others in a couple of minutes. But I mean, this is what will help to drive not only fintech forward, but I think just finance altogether. That a service like this, even for a retail brand, plug right into this, and boom, bank accounts and bill pay, and I mean, it just keeps your customer and your customer base without having them to go outward to find these services. It's it would be a genius move for anyone, and obviously Marqeta powering it is it's a big deal for them.
So it makes me wonder, I mean, how long before big brands this becomes just standard? Like, are we going to see a Nike bank account, an Apple bank account, a Chipotle bank account? I mean, it's like, who knows, the big brands that are out there, if it's becoming easy, and it obviously is becoming a lot easier. And I don't think we've seen kind of what the end game is here, how this is all going to play out. And one thing, I mean, banking as a service is just exploding, it feels like, right now. And, doing so in such a way that, is I think, we don't know where this is going to go. The OCC has been somewhat quiet. I read an article that people are wondering what they might have up their sleeve because they're not a huge fan of banking as a service, but we'll see. Certainly really interesting.
The one thing I think that you will see, and I'm not sure if we'll have Chipotle with a bank account in the traditional sense, but I do think what they can use is a bank account like product with rewards. I think you're going to see like the reward system as we know it be revamped through banking as a service, and how people can spend, and those rewards maybe get dumped into that account, and they can use it on other partners of Chipotle or back at Chipotle. And if you use that money, then you get another 20% off. And I think it's a way we're going to see it as kind of this new wave of how rewards are done, which I don't know how they're eventually going to be done, but I think that's a path that I see a lot more easily than Chipotle offering bank accounts.
No, that's good. I mean, like rewards, I often think that, we have credit card rewards, which are pretty ubiquitous these days, but I go to Chipotle regularly, and I have every 10th burrito is free or thereabouts. And, so I'm building up points every visit. Why can't I use those points and go to a Nike store and buy and use my points there? There's no sort of, like all this sort of, I think loyalty is, anyway, we're getting a little off track here, but loyalty is,
I think they get there.
Opportunity.
I think they get there. And what that example that you want, I think they get
maybe
there.
It's crypto tokens.
Maybe.
Anyway, now we talked about Marqeta. Now we're talking about Adyen. That also, I'm sure these companies didn't realize each other was going to make an announcement, but Adyen is also offering banking services. Not in quite the same way that Marqeta is doing it. Marqeta is offering many different products. It looks like Adyen's starting off with checking accounts and loans, small business loans, because obviously Adyen, massive payment processor, and done. They have very big presence in Europe, getting more and more big in this country as well. Work with many of the major brands, and they announced at Money 2020 they are going to be offering banking services too. Thoughts?
I mean, the big difference here is that Adyen has the licenses themselves.
Yes.
They have both the European and they have this, the OCC approved this foreign something bank account. I forget the exact name of it, but so they could probably see the even bigger benefit from this than say a Marqeta or someone else in terms of the bottom line. And I think Adyen is right now third in payments volume. I think it's PayPal, Stripe, Adyen, and then the others follow them. I think it's like 1.25 trillion, 640 billion, 567 billion, and then onward. So I think they're going to see this, as a pretty big boon to their business. No one's going to know who Adyen is because it'll all be white labeled, but they'll be powering it.
Mm-hmm.
I just couldn't believe how long it took to get, this has been a long time coming. In 2017 is when they first got their European banking license.
Right.
And then they've had to apply over the years. And finally, in I think 21, they got their foreign branch thing from the US. So it's been a long time coming, and it is cool that they have the deposits, I guess, themselves, even though I guess it'll be through a white label.
Mm-hmm.
It does mean they'll hold the risk of those loans, though.
Right.
So that
true.
could backfire in some way. But.
Yes, indeed. Anyway, moving on for our last Money 2020 story of the week, because there was other news that actually happened this week. Cross River, our good friends at Cross River, been with us from the very beginning here on this exciting fintech journey. Kevin, you wrote a piece about their announcement. Why don't you tell us, tee up what they did?
So Cross River is basically powering Amex cards for the fintech community to reach out to the American Express network. And the founder said, it's great to collaborate with them. I mean, it's a huge network. It's cool to see another win for Cross River, frankly. Everyone that always works with them always says it's because they just have such a suite of products that it makes it easy to say yes to a decision to partnership with them, because it just offers so much, I guess. I like to see it. It's cool. I don't know. Who did I talk? I talked to Ron Shevlin about it, and he said, or I asked him what major things he's been seeing at the conference. He's been like a lot of embedded card stuff, a lot of people powering new credit cards in ways that they haven't before. And that definitely fits the theme.
I mean, what was this, like the only one from the portfolio missing?
I mean, that's the thing.
It's just giving options. It's smart, and why not give the ecosystem as many options as possible.
Exactly. And because all the card offerings that we've seen to date have been Visa and MasterCard.
Yeah.
That's really it. So you haven't really seen fintechs offering an Amex card, and now through Cross River they'll be able to. So it'll be interesting to see how much uptake that gets. Okay, moving on to stories that didn't happen at Money 2020. So this was an interesting one. The Wall Street Journal, I read this morning over my breakfast, and it was Andreessen Horowitz went all in on crypto at the worst possible time. This is basically talking about they got a $4.5 billion fund. We talked about this on the show back in May, biggest crypto fund ever. And, they've certainly done well. And this was obviously in May. Crypto we hadn't even seen the Terra Luna crash yet, so crypto was down, but not dramatically. And it was basically, this article was really interesting because it was almost like a profile of Chris Dixon, who is the partner at Andreessen that is really leading the charge when it comes to crypto. And I didn't realize how early they were. Chris Dixon was investing in Coinbase in 2013. Coinbase, that must have been either a seed or a Series A, done extraordinarily well out of that investment, I am sure. But obviously, since May, things haven't been very good in crypto land, as far certainly because they invest in tokens as well as in companies, and certainly been a rough ride. What do you guys think?
I mean, they're believers.
Yep.
I mean, that's what it comes down to. They're believers, and their thesis is they will have enough Coinbases in the portfolio for it to pay off. And the only way you get there is taking all sorts of bets. And some of that will fall completely flat on their face. But I mean, Andreessen has proved their thesis many different times over. I mean, Mark made his made his name on kind of the early days of the internet, and look what that's turned out to be. They see it as the same thing.
Yep.
Is that this is the early days of the new internet, programmable money, and so their view is eventually they'll be right, even if it takes some pain, even if it takes a lot of pain in this winter time. The one thing I'll say though that kind of proves that thesis somewhat sitting here today is just look at the names that have gotten into crypto this summer and this fall.
Yep.
BlackRock, Fidelity, others. I mean, you're seeing huge asset wealth managers or banks get involved. BNY Mellon, the oldest bank in the country. So eventually it's going to obviously pay off in their mind. We'll see. But they are true believers.
I would say they definitely are. I didn't even know that they were that early on Coinbase. They've been in it for that long, and this specific fund, the 4.5 billion, it got caught up in it's organized at the right at the height. It feels like in May, and then it's been down since. But they got caught up in a crypto bull run. We've all been there, frankly. And it I don't know, if you look at their last fund they raised for crypto, I think it was in 2018. And that was 350 million, which I guess is pennies in comparison.
Right.
But still, they raised it when all the prices were crashing before, and it did so well that now they're one of the biggest names. I mean, they have been, but so can they do it again? I mean, probably, if they're full-time believers and they just wait for these frequent runs.
Mm-hmm. What was fascinating to me was the Wall Street Journal article has a chart of all of Andreessen's funds, the returns through the end of 2021. It is spectacular what they've done. Like the $350 million fund you just referenced there, Kevin, 10.6x return.
Yeah.
1,000% return, basically. Obviously, it's down, but it's down 40%. So it's like a 600% return now for that fund. But all their funds have done extremely well. Their Fund 3, 2012, 9.7x return on investor money there, and that included their Coinbase. Obviously, it was a massive win on that, and they've just this chart just blew me away because they when you look at all their funds, they've crushed it. I mean, they haven't their worst performing fund that in the fintech space anyway was it's like 3x for a bad performing fund over just a relatively short,
over a couple of years, right?
That's not even a bad return.
Yeah.
Considering.
So there's a reason why they're the most respected name in venture capital right now, because they have got the to prove it. And obviously, it's a down year this year, but everyone's down. So I don't feel like that's a bigger surprise. So moving on, we've got a couple of I guess negative stories to share. First one, Adam Dell's company, Domain Money. Adam Dell, as the founder of Clarity Money, he's spoken at our events in the past. They have looks like they're pivoting. Is what this is. This is an exclusive story from The Information. And basically they've laid off, or at least over half the company has left, and we don't know what they're pivoting to because that doesn't say. But they had this product that was really all about making crypto investing as simple, and investing with crypto and with stocks at the same time. And it's just tough business to make money out of, it seems, and they didn't really get much traction.
I mean, I interviewed them earlier. Was it late last year? Earlier this year, right after they had raised their round and that they had launched, and that their differentiator was they were basically using people to help give actively managed portfolios, and that coincided with the crypto winter. Because I think probably a lot of their people wanted to have crypto portfolios or heavy crypto portfolios instead of maybe a balanced view. Clearly has hurt them. And we'll see. I mean, Adam's super smart. He has a lot of history, and so I'm curious to see how they pivot. Clearly, Goldman found a lot of value in what he did with Clarity, eventually acquiring that, and he worked there for a couple of years. But it's never want to see companies do bad, but tough space to be in right now.
Mm-hmm.
Yeah, I mean, if my retirement account is down, why am I using like a retail investing app right now? Just everything's down. It's a terrible business. It's a terribly difficult business to do well in, even when things are doing great, because you're still competing against giants like Robinhood or Fidelity, Schwab, or what have you. So it stinks to see.
Yeah, and the reality is that this sounded like a great idea in 2021 when crypto was going up, and this was, they got $33 million in backing, so they haven't run out of money. Apparently they're pivoting to something else. We don't know what that is, but it's just a tough business, I think. So speaking of tough businesses, the Fundbox has laid off 40% of its 348 employees, according to this Forbes article. They have a US office and an Israeli office. It's a pretty big chunk for one round of layoffs. A lot of companies do like 10, 20%, but they went out 40% of the company. Apparently they still have $100 million on their balance sheet. They're not in any threat of demise, it doesn't seem like. But Prashant Floria, one of my favorite people, super smart guy, and said they grew too fast, and so they're bringing their business size back to pre-pandemic levels, is what it sounds like. So not good news if you're a Fundbox employee.
Well, you can replace Fundbox with what name in fintech this year? I mean, a lot of companies, Robinhood, we grew too fast.
Mm-hmm.
X company, we grew too fast. I mean, and it's hard to blame some of the companies with just the froth that was in the market and how easily that you could raise capital at one point. But I'm curious to see if some of these lessons are actually learned. Say in 5 years, if we have a similar kind of frothy period, maybe it won't go as frothy as the last couple of years did. But are they going to try to play the long game or capitalize on the frothiness? I don't know. Hopefully people learn lessons, but I mean, it's a lot of employees are out of work for a variety of reasons at a lot of companies, which is obviously a shame. And you just hope those people have the adequate skills to find another fintech to work for.
Yeah, there's going to be a flush of fintech professionals suddenly in the job market. It's going to get tough. I mean, Coinbase, how many names have done similar types of layoffs or different percentages, but still suffering from the same thing? There's interest rates now. There hasn't been my whole professional career, it feels like. How does that change not just the funding froth? How does it change everything that these fintech companies do? It's spooky.
Yeah, we live in very, very different times than we did last year. It's just
mortgage rates just hit 7 today.
7. The first mortgage I ever did, which was in 1990,
which kind of used to be normal.
Yeah, 7. Yeah. Mine was 8%. My mortgage was 8% in 1997. So it's not like it's unheard of, but that's 25 years ago, and for most people, that's a lifetime. When it comes to this. So I see we have a comment here for a LinkedIn user telling us about the Apple Card. We covered that last week. That was last week's news. So go watch the show from last week. It's available on LinkedIn, YouTube, and Twitter. Go find it. And so we're not going to talk about that now. But anyway, want to move on to Lending Club reported earnings last night, and pretty solid earnings report. Revenue up 24% to $305 million for the quarter. Earnings up 58%. Assets grew 43% to $6.8 billion. But their guidance wasn't as strong as what the Wall Street wanted. So of course, it doesn't matter how good their earnings report is. They have been hammered today, down 9.6%. Their stock price. It was, probably not unexpected given the guidance, but it's a pretty solid quarter, I would say.
It's amazing how a solid quarter in fintech still means not enough for
They're
investors.
profitable. They're a profitable company.
They're making money. Scott Sanborn said that times when consumers in their demographic that they offer their members, when their credit card rates go up or when they need to save more money, those are good times for Lending Club's business. But still, investors do not care. They don't care about what would have been a good quarter 2 years ago. It's nuts.
I really wonder how investors view Lending Club as a bank, a fintech, technology company. Like, how do they actually view them? Because if I wonder if they view them as a bank, would guidance have been as bad? Or if they're trying for these outsized periods of growth, like a fintech, or that might see kind of that jump in growth a lot more quickly than, say, a bank. I don't know. Curious how they view them.
It's a good question, Todd. I don't think they view them as a bank, and I don't think it's a fintech either. So
that's the tricky thing.
They're not like this rapidly growing company anymore. While they are growing, they've grown quite nicely. $3.5 billion. I mean, over $80 billion in loans since they started, and that is quite an achievement. And I think the thing that's most interesting to me is that this was an article in Protocol which I read that talked about the marketplace lending model is going to be struggling because a lot of these investors, they're leveraging, so they're getting a bank line, a warehouse line from a bank. They're getting that at like 3%, investing in Lending Club and getting 10% returns or 8% returns, whatever it is, whatever they're trying to do, and their cost of capital is going up. So suddenly they can't invest in the same sorts of loans. Lending Club's not going to suddenly double their interest rates. And so what was interesting to me when you dig into the earnings, Lending Club held on to $1.2 billion of the $3.5 billion that it originated in Q3, held on to it on its own balance sheet because it's got all these deposits that are coming in that it from its bank business, so that it can lend out. So it's interest income doing great. I mean, that's where I feel like they're in this morphing time where they're going from a fintech towards a bank, and they're probably going to be valued as a bank long term and not as a fintech at all.
Yeah.
But let's face it, a lot of fintechs are not valued as anywhere close to the way they were.
And that's when I think you might see them, begin to outperform or at least get better guidance when they're viewed in the prism of, hey, we're a bank.
Right. Anyway, in closing, Kevin, why don't you just give us, just another minute or so, just sort of tell us a little bit about what the mood was like at Money 2020. What was it buzzing? How was it?
It was buzzing. I've never been to Vegas before, so that was quite a town. I think I need to be multiple more zeros behind my name to feel comfortable walking around wasting money like that. But I guess besides that, the feeling was, I don't know, less about crazy valuations, it didn't feel like there was a ton of money in the air or something. Besides the excellent layout, the cool booths and stuff, most of the talk was about compliance, regulation, changing interest rates, and about sort of what to expect next, about holding on, about, I don't know. Most people I talked to were talking about cool things and cards, but a lot of the conversation was about how can something change in America that would make it so super apps could be there, or what could change next for things to grow, not necessarily what this is really hot right now. I don't know. There wasn't as much crypto talk as I thought there would be, really at all. There was definitely players there from the ecosystem, but they're all sort of looking, I think, for the Fed, especially because, the interest rate rises and stuff, we're looking for a reason to calm down, I think.
Right.
Yeah.
It's interesting because Todd and I, we were both there last year, and crypto was everywhere. I mean, it was almost like a crypto event, it felt like. And
really?
It was a bit more subdued because this is really still just coming out of the pandemic. It was nowhere near a record show. But it's good I'm really pleased to see they got back to record numbers there, and seems like it was a very successful event. Anyway, that's it for us for another week. Thank you very much for watching or for listening. We'll be back same time next week. Before we go, though, just a quick reminder, if you're interested in Latin America, we have the leading fintech conference happening in Miami. You don't have to leave the country. You can just go to Miami and we will be covering the Latin American fintech market over 2 days, December 13th and 14th. Go to fintechnexus.com to find out more.
Yeah, buy your tickets.
Buy your tickets indeed. It's going to be huge. Okay, thank you very much, Kevin. Thanks as always, Todd. We'll be back same time next week.
Thank you,
Pleasure.
Kevin. See you, Peter.
See you guys.